Media and technology, markets, policy, and the business of culture. Full disclosure, I'm Robin Farzad.
I mean, you've seen this with other sort of like highly credible G10 bond markets. You saw this in the UK, which is that if you push bond investors too far, if you push the deficit too far and you're too fiscally irresponsible, investors will punish you. And I think this idea that like people always flee to the treasury market in times of safety, it's actually not entirely holding true anymore. It didn't hold true in 2020 during the dash for cash. It didn't happen after Liberation Day. This sort of instinct, this muscle memory that US bonds are a safe place to go in times of crisis, I think you've already seen ways in which that's sort of faded.
Alice Fulwood, The Economist's U.S. business editor, on AI madness visiting emerging economies, China's continued stagnation, the Federal Reserve's bind, and the success of America's franchising culture. Stick around. Watch Full Disclosure on YouTube and listen to us on NPR, Spotify, Apple, and all of the podcatchers. We put them all at one link, fulldradio.com. Again, fulldradio.com. Please subscribe, rate us, tell your girlfriend, mother-in-law, friends, everybody, and catch me on CNN and NPR's Here and Now. Joining me from Washington, D.C., it is a joy to have you on, is Alice Fulwood. She is the U.S. business editor at The Economist, previously the Wall Street correspondent. She's a veteran of Wall Street herself. You can hear her go toe-to-toe with Wall Street luminaries and financial pros and academics alike on the hit pod Money Talks, which I listen to religiously. How are you?
Hi, thank you so much for having me. I'm always delighted to join you. I'm doing very well. It's not too hot and swamp-like in DC yet, so we're enjoying it while we can.
I will confess, in the interest of full disclosure, the name of the show, I always get some imposter syndrome when I have an esteemed, mellifluous person from The Economist on the show, and I tend to overcompensate. I like to use alack, agad, alas. If we talk about the car industry, I won't call it a sedan, I'll call it a saloon. I think in terms of investing, we have to throw a punter in there. Mm-hmm. So if there are any other words that can, make me feel like part of that fan, suffice to say, I read the thing religiously from cover to obituary.
Yeah, I mean, the obituary is the best bit, so you've got to get all the way through to the obit.
That is macabre.
I just mean that it's so beautifully written by our obituaries columnist, Anne Rowe. She always does a fantastic job. But yeah, no, I'm obviously a big fan of the mag as well, and I will do my best to titillate your British affinity or whatever.
Alas, again. Okay, but I have to ask you, you've been top of center. I heard a recent show that you had on, and this is a jump ball. Korea. Mm-hmm. Okay, this was a frontier market in the mid-20th century. It's become one of the biggest emerging markets. Clearly, we know national champs like Samsung, AK, and the other players in there, Hyundai. Where did it come out of that this market that's been absolutely gangbusters, doubling and tripling over the last 2 years, has suddenly become maybe the world's foremost AI play? You guys dug into it a bit. Yeah,
so I guess one of the things that's interesting about the sort of AI boom is that, if you cast your mind all the way back to like November 2022 when ChatGPT dropped, and you can go back and you can sort of read the NVIDIA earnings reports, and really sort of no one had any idea that this was coming. And then you see the sort of remarkable run of NVIDIA, and there was all of this sort of focus on them and their chips and how important their chips were to, as the sort of the equivalent of the selling pickaxes during the gold rush. They were the company that was making all the stuff that was going to allow the sort of AI revolution to happen, and people like OpenAI and Anthropic to sort of make these really exciting frontier models that can do all kinds of stuff. And for a long time, it was sort of somewhat narrowly focused on that this was the company making all the money because they made the best chips. And what you've seen over the last, I guess, probably 18 months or so is the sort of the AI gold rush seep into every company that touches anything that could possibly be to do with sort of building a data center. So it's not just NVIDIA's chips, it's sort of Broadcom and it's the memory chip makers like Samsung, like SK Hynix. You're also seeing, this sort of boom in even, construction players, in real estate developers trying to hoover up land.
Caterpillar generators.
Mm-hmm.
I mean, it's...
Yeah, if you make generators you're holding the bag in the no sorry you're not holding the bag, you're holding like all the power, because like everyone needs a generator, everyone needs a transformer. There's just been this sort of enormous gold rush as you've had all of the sort of the big hyperscalers and other sort of capital pools really just sort of plowing money. I think it's sort of they're on track to spend probably about $800 billion in capex. That's just the hyperscalers this year, probably more than $1 trillion next year. And what's happened is that, they don't just want to buy Nvidia's chips. Everyone's buying every chip they can get their hands on.
Look at Intel, which was left for dead. You guys have covered it a year ago. You talk about seeping and a rising tide lifting all boats. This is where it has so lopsided the United States market that all that hungry restive capital is going everywhere around the world looking for any possible play on this AI superscaler build out.
Yeah, exactly. So it's sort of you've morphed from the initial phase where everyone was really excited about like just the companies at the cutting edge into basically every company that touches any part of the stack for the build out, and that includes sort of the two massive Korean champions, Samsung and SK Hynix, and they sort of specialize in memory chips. All of them specialize in memory chips, but memory chips are the thing that they're doing that are really selling like hotcakes right now. And you've seen a sort of huge run up in Korea's stock market. It's added even sort of real meaningful amounts to GDP growth. It's probably going to grow closer to 2% in 2026, but up from 1.2% in 2025. So that's a sort of real meaningful boost. You saw the sort of Samsung workers go on strike, sort of picketing for higher wages to get a share in the spoils of that company's gains from the AI boom. And it's kind of interesting because Korea was one of those countries where, the sort of Asian tigers, they got rich along after Japan. Korea and Taiwan were the countries that got sort of rich alongside China. And there was this sense that, they'd hit maturity and that they weren't necessarily very exciting places. They're still included in emerging market indexes, but they shouldn't really be because they're developed. And now you have this sort of boom.
I was waiting for you to say this. There was an aborted coup attempt 2 years ago. There are some little flecks that remind you it's not quite ready for developed market status. I mean, do I remember that correctly? 2 years ago, where there was an attempted push.
Yeah, there was this sort of crazy coup where.
I mean, in fairness, the United States had that too. So I was like, I'm sorry. Go ahead.
Yeah, I think it's. I mean, South Korean politics is always so interesting because all kinds of countries talk a big game about sort of like adversaries and defense spending and needing to protect themselves against rivals. And in South Korea, it's like absolutely abundantly true. I visited Seoul when I lived in Asia, and you can do these little tour buses where you go and visit the DMZ, and it's wild. It's like an hour. It's like an hour from Seoul that you are in this sort of like unbelievably heavily military occupied zone. It's like standing sort of face to face with people who, if you step over this concrete line, they will immediately shoot you. It was really bracing, but I do think that affects the sort of like political local mood in terms of how worked up people can get about sort of potential threats. And it's anyway, this guy, he seems like he went off on one and thought that everything was
I'm reminded in my investing adulthood, I was in the markets. I worked in the asset management industry in the late 90s, and I remember this scene of during the Asian financial crisis in 1997, which really Malaysia, Indonesia emanated, but Korea and the others really felt it. It was a dark moment, a near-death experience. You can go back and look at it. People collecting gold and hard currency in the streets to donate to the central bank. Like talk about it like a Korean, a spirit. It absolutely was not this flimsy market. And then it came back and had such vindication when the early aughts had the emerging markets run. But as you and I know, and you've covered this in your show, emerging markets and international investing writ large have been dead for 15 years until they had a rip-roaring 2025. There seemed to have been a belated understanding that with the NATO trade, Europe and Japan and the others, they had for long put off major infrastructure and defense spending. Suddenly there was a realization that Korea was sitting on this AI gold mine. Suddenly everything seemed to have turned corners. And I know it's like waiting for Godot for you because the S&P and the Mag 7 thing has been outperforming for so long. But are we finally seeing vindication on the kind of international investing front? It's such an ancient art form, investing abroad.
No, I know. And, it's like even the sort of greatest American investors of all time, people like Jack Bogle and Warren Buffett were like, oh, well, diversification's good, but you can probably just be diversified in the States. You don't need to worry about those sort of silly overseas markets. So it's one of those things where it's been so hard for so long to convince people that they should even bother to take a look, because American stocks have been on this sort of unbelievable tear since the global financial crisis. They have sort of risen from taking up sort of 40-ish% of the global equity indexes to something like 2/3 now. It's just been a sort of complete domination of every other equity market story, and because America is so big, in some ways, are you really going to spend all this effort and time looking into all of these other countries where the returns have been sort of pretty dismal in comparison over the last sort of 15 or almost 20 years?
Is it optional? I mean, I did speak with the late Jack Bogle about it. He believes that it's just a currency thing, that when you have a weak dollar, emerging market currencies or an asset, a commodities play, some people in the world think it's completely optional. Others are saying it's delusion. I just showed you this chart from Dimensional that said Japan in 1990, a year after its market peak, commanded 42% of global market capitalization. That's down to 5%. The United States has gone from 32% to 63%. And meanwhile, I look at how much the country has changed. We went through the era of BRICS. We have these huge, the Iron Curtain fell. You have these hugely growing markets, these young, consumer classes that are coming in market. But then there's a school of thought, as you know, that says it's fine. The S&P 500 sells to them. It caters to them. After all, Coca-Cola, Caterpillar, and the like, they are chiefly, half international, half US plays.
Yes, you do get some of the sort of like consumer demand of other countries coming through. I guess, on this question, do you really have to look overseas? I mean, imagine that the US is Japan now, and then in, 4 decades' time. You really wished that now you would have looked overseas. So I guess I don't think America is Japan, but you do get these sort of super cycles. And then, because America is so big, people forget. I do think that there are very interesting and compelling equity stories around the world. A lot of the outperformance in 2025 was the currency story, but that doesn't make it any less real, in that the dollar could continue to depreciate and it could continue to be appealing to invest in other markets, like with that being part of the reason. I guess the things that make overseas markets compelling now are the sort of list of factors that you mentioned, things like the reindustrialization, the sort of NATO defense spending, idiosyncratic stories in places like Korea. The other sort of big reason that I think you need to look overseas, Anna, I know he's a favorite investor of yours as well, but it's, I guess, the sort of Cliff Asness thesis, which is you should go and look for stuff that's cheap. And it's very, very hard to find cheap stuff in America. I guess we can talk more about this if you want, but his general.
Well, it's a hard discipline, as he said. In the 90s, when every investment committee was coming around, and you have to tell them, "Hang in there, we'll be vindicated. Small value, international, they will come around." And year after year after year, even after earnings estimates may have topped in the late 90s, it took until March of 2000. And for as much as people must buttonhole you, Alice, and say, "Does this resemble Y2K? Does this resemble Cisco and the other players and that fateful top of the markets?" Everybody, after all, cites the Schiller cyclically adjusted price earnings multiple. But in many respects, it does seem so very different. When I listen to you guys talk about Korea, these are companies, it really truly came out of nowhere for Samsung. I believe in efficient markets to some respect, but this isn't hype. This is suddenly people are paying dearly for their chips for a whole other off-label purpose. And the company's market revenue is skyrocketing, so much so that the labor force is clamoring for more money from them. It's like I found like Bitcoin in between the cushions from 2010, and it makes me think about your seepage metaphor. How much of this is the rest of US trade and money and the excess savings that everybody has internationally that's going to go seeking this theme out in places that nobody ever expected?
Yeah, I mean, that's a really good point. I guess on this, is the AI bubble the next dot-com bubble idea? I mean, it is the difference between software and hardware, which is that the sort of AI, the internet bubble was all, you could put through together a PowerPoint presentation, you could raise millions of dollars. And it was all sort of based on hot air. The remarkable thing about the sort of, at least the initial phases of NVIDIA's rise, is that it wasn't a valuation run.
It was a revenue and profits
thing.
Their
price to earnings multiple went down as they went
Repeat that. Your market capitalization goes from 300 billion to 5 trillion. But the earnings, the denominator is going up so much that your valuation actually fell.
Yeah. So their P ratio dropped during their sort of like insane bull run to being sort of a multi-trillion-dollar company. So it's not like there's a bubble in Nvidia's share price, right? Like that's all based on the real revenues. You have to sort of go up one level and think, okay, so you have all of these people, you have like Meta, Google, Amazon, Oracle, SoftBank, the neo clouds, FluidStack, Core, all these people sort of clamoring as much as they can to get their hands on as many NVIDIA GPUs as they possibly can. And now also
which
SK
each
Hynix.
cost about, I mean, for our listeners, our lay listeners, they cost about what? These are $30,000, $50,000 units.
Actually, I don't know how much a single GPU costs, but I guess like if you're trying to build a data center with like 1 gigawatt of power, which is like a useful unit, that's like about how much you'd need to train a frontier model in like a few months time.
Wow.
That whole thing probably costs like $50 to $60 billion, of which half is NVIDIA chips. So they're getting like 30, maybe $35 billion.
They could get whatever they want. I mean, Jensen Huang, as you know, is a rock star now.
So yes, the question you have to ask is not like, is there a bubble in NVIDIA share price? It's, well, so is all this CapEx going to come good? And you can buy a lot of sort of gigawatts of data center with $800 billion. You can train a lot of frontier models. You can buy a lot of compute. I think for a long time I was like, oh, I don't know about this, guys. Like that's a lot of money. And some of they're issuing debt.
Indeed, I was up in Northern Virginia last week and in the data center corridor, which we'll discuss. And I was wondering for a split second, like, will these be the unlit fiber optic cables of the early aughts? Will it be like the Japanese theme parks in the movie Spirited Away, like vestiges of bubble mentality, overspending, just gone awry? How are they going to be repurposed in the future? And yet you have many guests on. You guys are writing it. Many people on Wall Street are saying this isn't even like the second inning of this build out. Yeah. It's pretty binary. You either have to build it out and commit to it or you don't. And to play, you have to be a mega scaler. You have to be out there buying these chips. We know it's been a real estate play. You know, this massive utility acquisition, Dominion here in Virginia with NextEra Energy, like at the second and third order effects, our minds are barely trying to get around it.
So the thing is that like, if you think about the sort of data center infrastructure that we have now, it's clear that OpenAI and Anthropic and all of these players are constrained, right? They don't have enough data centers for all of the demand that they're seeing for their tools. Like it's not, you don't need to worry that they've invented this thing and they're building all this stuff and no one wants to use it. People clearly want to use it. Claude is having to, Anthropic's having to ration tokens.
They're throttling people.
OpenAI shut down Sora. Like that was clearly a sort of compute-based decision. All of the frontier models can't give people enough of the AI tools that they want. So it's clear that there's like obviously a case for there to be more data centers built to fulfill that demand. The really difficult question to figure out is like, well, how much? Because, every time these models get better, you think, well, maybe that will rationalize the demand for data centers because they become more efficient. But actually, it just induces more and more demand to use these tools. And so what you're seeing now with these sort of massive $800 billion, which is going to buy sort of like 10 plus gigawatts of compute, which is probably like 10x, maybe only 5x what OpenAI and Anthropic currently have access to. Is that possibly going to be is there possibly going to be enough demand? I think the answer is probably yes. You've basically only seen the AI tools revolution disrupt coding, and it's seeping into everything else. But like science, healthcare, media, like all of the other industries in which you think that it might come to be as sort of widely used as it is in coding, or maybe almost as much, it's really only just scraping the surface of those industries. So yeah, huge amount of spending. It's very difficult to figure out where demand will end up, but I guess I understand why people are gold rushing in the way that they are to build.
I mean, indeed, have we ever in the modern era, let's say 200, 250 years ago, and you can adjust for inflation, have we ever in the United States seen a capital spending cycle of this enormity? Like it seems to pale, the railroads, if you look at those, if you look at everything else that was built, the radio, everything else that happened. And I'm thinking in my lifetime, it was, there was a great big Goldman Sachs tome in 1999. It says building the broadband kingdom, and trillions went into building fiber optics and networks and the like. And I think 9 out of 10 of those companies have liquidated since. And at least there was creative destruction coming out of that call centers were able to light up fiber optics and people picked up the pieces. But I'm wondering if, a part of me is scared by the huge multiples, by the very number of $1 trillion players we have that are almost like, the difference is they do have revenue in this case, but it is a lopsided United States stock market. But then there's plenty of evidence, as you know, that this is very early innings, very early stage.
I guess the thing that scares me is, you have SpaceX, OpenAI, Anthropic all filing for their IPOs. They're trying to raise a huge amount of capital. You're seeing a lot of like debt issuance as well. You're seeing capital be reallocated from, I guess the sort of hyperscalers are spending all their cash, but then you're also seeing like players like Blackstone, trying to fund special vehicles to fund data center expansion. Like
It seems like, it does
everyone's
smack of like kind of late stage dregs, which we used to see. High, reaching for the tail end of these things, like at the end of the PE bubble, but we don't know if that's the case.
Yeah, and I do think it's hard to think that like we're at the tail end of the AI token demand cycle. I think it's like pretty tough to make that case. So I do worry about how frothy it all looks. With every sort of real technological revolution, there is this kind of like frothiness that goes along with it. Some of the financing now, we've burned through the easy money to invest, and we're pushing into
Alas, where are the punters, Alice? Where are the punters? I thought you resisted the urge to say the tail end of the AI build-out boom is nigh. But I digress. Full disclosure, I'm Robin Farzad. It's my joy to be talking to Alice Fulwood. She's the U.S. business editor at The Economist. She hosts the indispensable Listen Money Talks podcast on Economist Podcast Network. You did cover Wall Street, and in the past, you worked in South and Southeast Asia. Tell me about that versus what you see nowadays in that region. It hasn't been talked about all that much.
It was interesting. I covered sort of like Malaysia around the time that oil prices were really all over the place. I was covering Indonesia at the same time. Philippines when Duterte was in charge, like those kinds of places. And every day was a sort of different. Well, there was a lot of fixation on these countries are running they were always running big fiscal deficits. They were always running big current account surpluses. And it was like, oh, when their currency is going to go through the floor. And that's like a very classic sort of emerging markets playbook. And it has been kind of strange in the years since. Like that was a pre-COVID time. It was before every advanced economy in the world was also running a massive fiscal deficit. And it's been sort of interesting to watch some of that sort of EM playbook roll out.
Were you responsible for that cheeky Economist headline, "Talk Duterte to me"?
That was not me, I'm afraid.
Oh,
I did publish a research note. If you like it, you should put a ring it on it about the Malaysian economy, which was that was a real winner.
You guys are so good. Which does remind me, again, I'm going to bring up this gigantic dimensional yearly yearbook. I think it's called Matrix. You can't really see it. Maybe I'll put it in the show notes. It does compare market capitalization proportions globally, 1990, 2010 to the present. What's stunning to me is that China remains such a backwater. In spite of China now versus a year after Tiananmen Square, it has taken tens and tens of millions of people out of poverty. It has become the champion of EVs, solar, all these other things, the manufacturer to the world. We used to debate World Trade Organization and most favored nation status. That's all kind of penny ante at this point, and yet China's markets remain a backwater. There's something about it. People don't talk about investing in China. People talk about emerging markets ex-China. Even though China, I don't know how you break out the distortion, like where the government ends and the private sector begins. Its market hasn't done anything.
Yeah, I guess if you put your feet in the shoes of a portfolio manager, like a big international portfolio manager, and you're like, okay, I'd love to get China exposure. How am I going to do it? It's very difficult to get your money onshore in China anyway. And even if you do, there are a few ways to get guaranteed fired as a PM at an investment fund. And one is that you invest your money in a place where capital controls make it impossible to get it back. Either sort of in the, even now that's sort of very tough with China, but they could always tighten things if there was some sort of crisis even further. And so it's just, you try to get China exposure through other avenues, like often, maybe Vietnam. That's like the sort of China.
The Philippines, or some people said Brazil was a play. Copper in Peru was a play on China. I always wondered, and I wanted to ask you why you had to go through, I guess it was the checks and the filter and the proxies of other emerging economies. Meanwhile, China has performed, yes, it's centrally planned, an economic miracle. Why is Beijing so content to keep its stock markets a kind of a backwater?
Yeah, it would be great to ask them. But I guess you can't foster sort of really robust, dynamic capital markets, stock markets, like America has, if you have capital controls. Like I think that's just the long and short of it. And they clearly don't want to get rid of them because they sort of like having control over their currency and interest rates, and all of the wealth that's created in China. I mean, especially this comes up all the time when people are like, "Oh, dollar dominance. Is there a threat? China's the biggest rival power in the world," and it's just it's impossible for people to use the renminbi seriously as a rival while they still have capital control. So I guess it will be interesting if they ever decide to sort of loosen that grip. But until then, it's sort of hard. It's hard to get too seriously excited about their equity markets.
And let me ask you, in the post WTO period, let's say in the last 25 years, has China ever had a hard landing? In your time looking at the company, they've grown even anemically, or if you trust the numbers, or there was that banking and property and land disaster 2-3 years ago. We haven't heard about it so much, but do you ever wonder at night? And again, these are meaning of life questions I've always wanted to throw at you and David Rennie and the others. How does a hard Chinese landing play out globally? Like, does it ease their demand on commodities? Does it bring oil prices down? Is it a net negative for the United States if they have to sell treasuries? We had the China skeptic James Chanos on the show all the way back in 2015. I believe he's since retired. And the markets haven't done anything since, but it certainly has not, outside of COVID, had a truly hard landing in my adult memory.
Yeah, I don't think that it has. And I think, even if you don't believe the data and you think they sort of like embellish it or make it up or whatever, it would be obvious. Like, it would be obvious in trade receipts with other countries. It would be obvious in, as you say, like demand for oil and demand for sort of other commodities if they were having a sort of really sort of deep economic issue. It is sort of remarkable that they have managed to avoid a sort of calamity in that way. But I think what's happening instead is a sort of slower burn slowdown. And in particular, it really wasn't that long ago that the sort of big question that everyone was fixated on was like, when is the Chinese economy going to overtake America's? Like, when is this
And they
great
are not
passing of
talking
the
about that
baton
as much. Yeah.
going to happen? And I think it's conceivable now that it would never happen because their population growth is so weak. I mean, I guess the US is trying to rival it on that now with cutting off immigration, but population growth has been so weak that it's sort of hard to see how it sort of continues the momentum to necessarily sort of eclipse the US if the US sort of keeps growing and expanding as it has done in the past, except the very recent past.
I picture you on Embassy Road or one of these salons in Georgetown, and somebody comes up to you and you're nursing your PIMS. I don't know which job. And they say, Alice, I know you get asked this a lot, but is it possible that China is the next Japan? And I know that's hoary and cliche, but considering the nightmare that Japan has been for the better part of 40 years now, considering the stagnation, that it's gone nowhere, that it went from being at this pinnacle of momentum and zeitgeist and whatnot, and effectively being in a deflationary demographic decline. I remember seeing that in 2011, Bloomberg ran a story that adult diapers overtook baby diapers for the first time in Japan, the sales of those. And we see all sorts of things happening. There's this constant fear that one of these overvalued markets or one of these misunderstood markets is going to get hit demographically and bubble wise, and it's going to take a generation of investors out. Do you ever worry about China doing that?
Well, I mean, it's sort of hard. I guess it's hard to get exposure to China, but obviously, if it had a real nightmare, that would affect a lot of things. Very hard for me to bet on the idea that you sort of first posited, which is that anything will become the next Japan, because Japan's just so unique. It's so hard to find ways to extrapolate from.
Well, demographically, I mean, the childbearing thing. We used to think that this was a problem, and now they're pleading with people to have children, as Singapore is, right?
No, exactly. I mean, the sort of fertility crisis it's obviously sort of most acute in China, but is an issue to various degrees all over the world. It seems like a lot of things went wrong in Japan all at once. And maybe that's sort of why, in particular with like the equity market comparison, things look so sort of catastrophic compared with their sort of great rise. The thing is that like in Japan, although people worry about sort of low growth and low inflation, there is this sense that they're sort of like happy with what they've got. It's an anathema to American capitalism, but like the Shinkansen is fast enough. You hear all these stories about these sort of like unbelievably good tiny Japanese restaurants where like the Michelin Guide wants to give them a star, and they reject it because they say like, oh, if you do this, I won't be able to serve my local customers who come in every day. There's a very good book a few years ago by Dietrich Vollrath called Fully Grown.
It's like the proud Mittelstadt. I think about
Yeah.
these things, and the people that are like, I don't need to conglomeratize. I don't need to internationalize. I don't need to be listed on the S&P 500. I make my Wusthof knives. Leave me alone.
Yeah, I think maybe they think they have enough. And if you go and visit Japan, it's hard to disagree. It's a very nice place to spend time.
Full disclosure, stay with us. This show airs on NPR, Spotify. You can watch us on YouTube. We are on all the podcatchers, including Spotify, Apple, Podbay. Gosh, I'm sure I'm somewhere on MySpace and Friendster. Check us all out. That one neat link, fulldradio.com. Again, fulldradio.com. A shout out to our radio listeners on WVTF, Radio IQ across the great Commonwealth of Virginia. We are out west in California on KPPQ in Ventura. We are in the gorgeous mountains of Asheville, North Carolina on WPVM. Holler if you too would like us on your air. My DMs, alas, are always open. And you can catch me every week on both NPR's Here and Now and CNN. If you're just joining us, my esteemed guest is Alice Fulwood. She is U.S. business editor at The Economist. I love her stuff. In the interest of full disclosure, I know I'm supposed to be a little stiff upper lip with an esteemed non-byline guest like this, but I love it. I love Money Talks. I love what you do. I love that you could volley the serve with someone like a Clifford Asness, a sophisticated investor, an academic. You could talk in the jargon, but then you can bring it back to a certain level, and yet it's not, it's not like nursery school hour sitting around a book. So I think you cover yourself in glory. Talk to me about the Fed and the specific interest rate dilemma we're in right now. Inflation's still coming in hotter. There's a new Fed chair that Trump seems to prefer more, but you're kind of hedged in. You're not at that point where the entire market has been romancing aggressive interest rate cuts. We still see pressure. We still see clearly Hormuz and oil. And if you back out oil and groceries and the like, people in the States are in a foul mood. Part of me wonders if you need a true recessionary demand destruction scenario to finally vanquish the inflation that hit us starting in 22.
Well, first up, thank you for all of your flattery. It's as a British person, I am deeply blushing at all of that praise. But on to Kevin Walsh. He's been handed a really difficult situation. Sort of in the running to be Fed chair. The case that could be made for cutting rates was sort of somewhat reasonable. Maybe growth was slowing down a little bit, especially from the sort of peaks post-pandemic. The labor market was looking a little sort of slacker than it had been, and inflation was sort of reasonably well contained. And none of those things are really true seemingly anymore. There was a pretty good jobs number recently. Because of the huge capital spending that we talked about earlier on the show, actually the US economy looks to be doing sort of pretty nicely. Growth is pretty robust now, largely thanks to that sort of AI boom, capex. And then at the same time, like you mentioned, there's been sort of all of these sort of upward pressures on inflation. The sort of closing of the Strait of Hormuz has pushed up fuel prices, gas prices. It's pushed up electricity prices, and you're starting to see it affect grocery prices, most sort of cleanly through fertilizer channels. A lot of fertilizer goes through the Strait of Hormuz, and so things like tomatoes, which use a lot of fertilizer, are now really expensive. Some of those inflationary pressures are things that you might think you could look through as like supply side-y type stuff as the Fed chair, but very, very difficult to credibly make a case for rate cuts with a straight face, essentially.
Can they make a case for rate hikes, that you need more bad medicine to finally do this?
Yeah, I think you can certainly make a case for rate hikes more than you can for the reverse. And in some ways, like that would be not unnatural for Kevin Walsh, in that when he was a Fed governor under Bernanke before, he was like something of a hawk, especially about QE, quantitative easing, or the bond buying programs that the Fed was doing, because he sort of worried about it distorting markets, and he really didn't want the Fed's balance sheet getting too big and becoming too sort of unwieldy and so his sort of sentiments seem to be that the Fed should, be sort of restrained and not too interventionist institution. And that tends to go hand in hand with sort of hawkishness in general, which would indicate that, you should keep monetary policy tight and potentially sort of hike rates. The case for the rate hike, I guess, is the sort of everything that I just mentioned. The growth is fine. The labor market seems all right. And you do have CPI inflation, headline inflation at 3.8%, which is obviously above the 2% target. And it never really got back down below the target post-COVID. So it's now been above target for 5 years. And
So if you're a rules-based Fed, right, and you have a dual mandate as full
Mhm.
employment and to keep inflation arrested, and you're not supposed to be beholden to politics or midterm election stuff. Like, could you imagine if they had to come out with an emergency rate hike, if they get much hotter than you have to answer to Truth Social in this case. And we think about
Mhm.
Jerome Powell, who was picked and appointed by Donald Trump. It was not long until he was being pilloried by that very same person and being embarrassed in the hard hat, touring the Fed and being accused of spurious allegations of spending too much on furniture and the like. We used to, it absolutely crosses a church state divide that, as you know, we never saw in the time of Bernanke or
Mhm.
Alan Greenspan and other people. There was a comedy among Democrats and Republicans. You just did not touch that third rail. There was a way to have moral suasion or extol the benefits of lower cost of capital, but you didn't make it as personal as it is right now.
Yeah, I mean, it's just sort of one of many norms that has been shattered by President Trump. To give him a sort of a modicum of credit, he had said that War should go off and be his own man. So I don't think. I guess it's sort of interesting that the case for rate cuts has fallen apart as soon as he's come in, and instead, if anything, they should be hiking rates. Although I don't think it's a sort of slam dunk argument in that a lot of the reason that inflation is going up does seem to be sort of supply side shocks, which is something that you can't really solve with rate hikes. So I don't think it's so obvious that they need to hike rates that it's sort of an abdication of their duty not to. Although I think that the case is a reasonable one. But it's interesting that it's all happened immediately as he came in, because in some ways I think that gives him more cover, because Trump doesn't want to immediately turn around and start berating him. It's too sort of embarrassing. He's just got his man. He's only just in. He's told him, you can go off and do what you want. So I don't know how much time Walsh has before he really pisses him off, or sorry, he really annoys
That's all
him.
right.
But I think he probably has more than a few months, and so in some ways, it's sort of easier that everything's happening right as he came in, rather than 6 months, a year from now. For Kevin Walsh, I guess we'll see what happens.
Just as a quick corollary or coda or dogleg or whatever you want to call it, you've covered the treasury market and debt writ large quite a bit. And I'm thinking, are we nearing the 15th anniversary of the United States getting its credit rating downgraded by Standard & Poor's? And to think about how much more indebted it is now, how much more profligacy there is, how much, I don't know of any kind of fiscal discipline or coming in there. We keep rolling over from a situation of fiscal cliff to fiscal cliff, holding this program hostage and the like. Is America ultimately just so exceptional, for all the talk of other reserve currencies or Bitcoin or gold, that ultimately people have to come back into the greenback? Ultimately, in a situation of panic, even if it emanates from the United States, they have to plow back into our treasury securities.
I think America is exceptional. I don't think it's so exceptional that the treasury market will always be the sort of reserve asset, global sort of risk-free safety asset that it is now. I mean, you've seen this with other sort of like highly credible G10 bond markets. You saw this in the UK, which is that if you push bond investors too far, if you push the deficit too far and you're too fiscally irresponsible, investors will punish you. And I think this idea that like people always flee to the treasury market in times of safety, it's actually not entirely holding true anymore. It didn't hold true in 2020 during the dash for cash, in that bond yields are supposed to, bond prices are supposed to go up, bond yields are supposed to go down in times of panic, as the equities market is collapsing. That didn't happen in 2020. It didn't happen after Liberation Day. This sort of instinct, this muscle memory that bonds are U.S. bonds are a safe place to go in times of crisis. I think you've already seen ways in which that sort of faded a little, and at the same time, they're really pushing it with issuance. Since the rating was downgraded, I think issuance has grown about sort of 8% year over year, roughly, over that time period. There's $32 trillion outstanding now. You compare this.
$32 trillion outstanding.
Yeah, it's massive. It's
I mean, the interest alone on that, if you compare it in the pie charts to all these other programs that we have, are discretionary and non-discretionary, it is a real opportunity cost. It's not theoretical.
Yeah. And you're also seeing like all the ways in which, the reason people worry about too much fiscal spending is because it crowds out sort of other opportunities for capital in the economy. And this was a sort of weird argument to make when all the tech companies had a load of cash and, they're actually sort of companies sort of didn't look that indebted. Households actually didn't look that indebted post 2008. But now you're seeing like real massive need for capital. And, at a macro level, if the government's borrowing loads of money, there is just less money for other sources to borrow. So yeah, it doesn't make any sense. It doesn't make any sense to be running a 7%
I
fiscal
will say,
deficit.
Alice, for my part, 5% starts to get tasty on a 30-year treasury. But I don't know, looking around the corners and imagining what inflation will look like, 7 or 8% seems more apropos in a case like this. And just the last point on this is the wild card is that there's such an abundance of cash and restive generational money. You read all about boomers and Gen Xers and this $20 trillion inheritance. That's always going to look for yield and return. And that seems like it's bailing out Uncle Sam's profligacy.
Yeah, although I guess I wonder where it's invested now in some ways. Like I'm sure a decent slice of that is already in the bond market. So do you think that the people who inherit it will invest more in treasuries than their parents did? I don't know. I think they'll probably invest more in real estate.
So the last fine point on this, and I'll leave it because I want to talk to you about franchising, is if I might be so presumptuous as to assign a story to The Economist, I start every speaking engagement. We talk about institutional memory, and I show a picture of Paul Volcker chomping on a cigar with me as a kindergartner and a toaster, because the banks back then would give us 15% savings accounts, and they'd give you this splendid toaster or blender or food processor. And Paul Volcker was breaking the back of inflation in the early 80s. And I was like, how many of you people remember that out there? There might be some young bond investors. And I was like, indeed, does there happen to be in the audience a bond vigilante? I've always been looking for a bond vigilante. I dare you to find me one. Like, where are they? Are they like a coelacanth hiding somewhere in Texas? These bond traders that punish the government is like, I'm not taking 5%. You give me 6-7%. It seems like that's also theoretical. They used to exist, but now they're just part of lore.
Yeah, I mean, they existed in the UK. But I guess the people who invest in treasuries now, like, there are a lot of hedge funds. It's a lot of hedge funds. It's a lot of, price-sensitive investors looking for yield. And
are they like out of a Cormac McCarthy book? Is it like No Country? What does a bond vigilante look like? I've always wanted to ask you. You're like, relax. It's some hedgy. It's some 22-year-old MIT grad. I mean, but full disclosure, we're joined by Alice Fulwood. In the few minutes we have left, Alice, I'd like to. This is a U-turn a bit, but I love the package that you did and the series you did on franchising in the United States, because it's this other angle into wealth creation. So much talk about crypto and stocks and real estate, people who've had the benefit of capital over labor. And yet you look at, I didn't realize that franchising has minted so many American millionaires, so flush with cash, passing on money. You talk about that theoretical, the guy pulling up in his Lamborghini at the kids' baseball match and like, where did he make his money? In hedge funds, crypto? I was like, no, he has 25 guys, And every time I'm on a Broad Street, I think, how many franchises do we need in this country? We're over-franchised. There aren't mom and pops like the ones you were talking about in Japan. Tell me about that duality.
Yeah, so I guess my sense is that the way people get rich in general is not always the way people that is the way is the sort of stereotypes. It's not, as you say, it's not necessarily crypto. It's not necessarily like founding a tech startup. Actually, it's a lot of like hard work doing somewhat boring things. And franchising, I think, is sort of one of those things, in that it's not glamorous, like running a McDonald's, it's not a very chic thing to do. And you do need a sort of bit of capital to sort of get into it. But if you run one of these joints well and you end up sort of maybe adding a sort of second or a third, it can be a sort of real sort of engine of wealth creation at the individual level. And in some ways, it's this bridge between the real sort of like mega hit smash successes. Like obviously McDonald's is sort of it was a startup once and it's a huge, massive brand now. So is sort of like Chick-fil-A and Five Guys and, there are franchises and all kinds of things like hotels and Pilates studios and like lots of things now. It's a sort of bridge between those sort of big, hugely successful companies and that sort of independent, small mom and pop idea of what a business is. And the reason that it's kind of appealing is that it's very, very hard to sort of make an independent restaurant venture work. It's very, very high failure rates. And if you instead sort of join one of these franchise systems, a lot of the stuff is worked out for you. And there are sort of like meaningfully lower failure rates in the first couple of years, which.
So let me understand this. You're paying an upfront rate, right?
Yeah.
Let's say 150 or 200 grand buy-in. Let's assume it's a frozen yogurt, the hottest concept, or a Pinkberry or something. And then you're effectively riding their IP and their branding. You get all the same cups, the same product, and you give them a portion of gross sales every year. So it's a more asset-light thing of a way of riding what an international brand might be, as opposed to doing it all green sky, blue sky from scratch.
Yeah, exactly. So you'll pay sort of an upfront fee and then a percentage of revenues. The upfront fees sort of tend to be 50 to 100K, and then the ongoing fee is like maybe 5% for fast food, up to sort of 10% for some other sort of fitnessy type concepts. And the advantage is, like, number one, I spoke to the world's biggest franchisee, Greg Flynn, who's I think also the world's first franchisee billionaire for this, and he compared the sort of experience of running a franchise restaurant to a startup that he'd worked on earlier in his career, and he was like, it's hard to convince people to deal with a new business. It's hard to convince lenders. It's hard to convince equipment suppliers. It's hard to convince landlords. It's hard to convince customers. Like, all of these things you need to try extremely hard to do. And if you instead buy into a franchise, like, a lot of that work is done for you. And that sort of reduces, especially in the early years, some of the risks associated with it. Because the main reasons businesses fail is that they sort of don't have enough money because they didn't have any idea how much their startup costs were really going to be. And franchising actually sort of lays a lot of that out for you. And then the other sort of reason is that you sort of, no one ever hears about you. And it sort of solves a couple of those problems. And I basically think that it's interesting from like an economic perspective, because, you think about things like specialization and trade as like happening between countries, or division of labor as happening in the pin factory, like you hone the needle and I bang the end to sort of make it usable. But you're also seeing this sort of specialization across firms. So, the franchisee is just sort of working really hard on making it a really good restaurant experience, making sure that it's clean, it's staffed, and the food comes out quickly and is hot and all that kind of stuff. And then the sort of McDonald's, the franchise brand, is sort of, it's finessing the Big Mac, it's finessing the marketing campaigns.
But there have been various civil wars between, central office in Chicago and the franchisees of McDonald's. They fight back, like, food price shrinkage. Guys, you need to rethink the value meal. It's not always complimentary and copacetic.
No, of course not. And I guess, I had it described to me by one academic as almost like a marriage, the sort of franchisor relationship, which is that it's not always there's obviously going to be conflict, because McDonald's is taking a cut of your revenues. And so you're always going to want them to take less. They're always going to want to take more. And there's sort of a lot of other terms within these contracts where there might be tension. So one, for example, is capital upgrades. Like, McDonald's wants you to renovate the restaurant to look sort of in keeping with the sort of brand revamp. But that money comes out of your pocket. So, like, obviously there's tension there. I think that the reason to think that, like, that tension is just a sort of natural part of, like, any business relationship that happens between any businesses, and not necessarily something worse is probably, McDonald's could buy back all its stores if it wanted to. If this wasn't a good model, if it was too annoying to work with all these franchisees, they have way lower cost of capital. They have tons of it. There's something about this dividing up of labor, about how they, you give people the profits from these enterprises and then they work harder for you, that sort of really makes it sing. And, they've been doing it for sort of 70 years. So I think it probably works well enough for both parties, even if they grumble sometimes.
Reading your story and listening to the pod on it, I'm reminded of a conversation I had with a gentleman who has the Subway restaurant next door to the old Studio 54 in Midtown Manhattan. I used to work at a magazine 2 blocks north of that, and we would go and have lunch at this Subway as recently, I think it's 2002. And he claimed to be the highest grossing Subway franchisee in the planet, which is a big deal. And he was telling us about the dream. Back in the day, you might want to aspire to take out a Baskin Robbins or go work in a hotel or something. And now the dream, if you come from Bangalore and you have restive money, is to open a Subway and to roll them up and to exit to other regional players or buy them up. He goes, but never, ever, I'm telling you, if you do it, never, ever put samosas and pakoras in front and alienate your customers. I remember his lessons. But in closing, Alice, I wonder if it's part and parcel of this renaissance for actually trades, if you will, that cannot be snuffed out by AI right now. I mean, you could have done a package on all the HVAC companies being rolled up, on all the landscaping companies being rolled up by PE. I'm sitting down with my kid's basketball game, junior NBA, at the end of 2019, and this landscaper sitting next to me, he thinks I'm some financial expert. He's like, I just had so much money this year. I don't know what to do with it. Do I buy more trucks, more rolling stock? Should I put in the S&P? I was like, what a great dilemma to have. And you read in parallel about all of these smaller buyout shops going and rolling up service companies or masonry companies. And now, as you know, there's been a shortage and a renaissance, a rethinking of going and doing things in trade. Like, you know, it's the Bud Fox talk in Wall Street when he's in the hospital in the end and the son's trying to make amends with the father. He's like, quit pushing numbers around, go do something with your hands. Is franchising maybe the kind of the middle ground to that?
Yeah, so that was sort of one of the other reasons that I thought it was an interesting time to think about it, because by the nature of the businesses that become franchising, become franchises, it's essentially they need to have a lot of employees and be distributed into lots of stores. Otherwise, you'd sort of keep everything in-house. So by their nature, it's all of the in-person service businesses. Those are the kinds of things that get franchised. And those are the businesses that sort of resisted the disruption of the internet. They will resist the disruption of AI. You know, you can't. One of the quotes from my my world's biggest franchisee was, you know, we're selling food to people who need food. That's you know, maybe AI will make their sort of all their processes more efficient, but it's not going to disrupt them. And so it's one of those things where you're seeing sort of more interest from things like franchisees' kids in taking over than they are now in maybe going off to college and getting a sort of coding degree or whatever. I think it's sort of it's interesting. AI gets into everything. It's sort of interesting to talk about that, but it's also interesting to talk about the things where there's sort of opportunities that are more appealing as a result of its disruption as well.
Alice Fulwood, U.S. business editor of The Economist, host of Money Talks. Find me a word in closing that encompasses both gratitude and humility. Like, I'm so grateful that you came on, and yet I'm so embarrassed that I'm not of the caliber of, I feel like I'm the punter and you are a boffin in the parlance of The Economist. But I clearly love your stuff and I hope it was worthwhile. And in a worst case scenario, I think a handful of people listen to this pod, including my mother-in-law. So, you know, you can't do too bad.
I'm very impressed by your sort of rich knowledge of British slang. Frankly, you know, this has been a refresher course for me. I've been in the States for a little while now. But, you know, thank you so much for having me. And I guess I'll go off and make a cup of tea or something, you know?
You're welcome anytime. Seriously, love your stuff. Thank you.
Thank you.
Full disclosure, special thanks to Ian Stewart. If you are listening to us on the radio, note that while we cut for broadcast link, the entirety of every interview is on podcast. We are on the NPR network, Spotify, Apple. Watch us on YouTube. You could find them all at one link, fulldradio.com. Again, fulldradio.com. And please do recommend us to a friend. A shout out to our home station, WVTF Radio IQ, Virginia's NPR news source. DM me to carry us on your air. And catch me every week on both CNN and NPR's Here and Now. I'm Robin Farzad. Thank you for listening. Back with you next week.